I'm David Alyward, founder of Tribeca Investment Partners. Calendar 2026 has every chance of looking like a continuation of the second half of 2025. Growth-focused markets likely continue the appreciation we saw in January. Consensus expectations for global growth throughout 2026 look solid enough. And where economies are growing, corporate earnings grow, and in turn, markets tend to rise. Also important to watch is the trajectory of US interest rates, which we predict will continue to ease. The relationship there with growth, as well as the relative strength of the US dollar, will be important to the strategies that we focus on at Tribeca. However, key to our view for 2026 is this: the continuation of this rally necessitates a broadening of the contributors to this rally. That's because the largely technology or portal type stocks that have dominated the performance of recent years are going to have to share some of that market leadership and consequent cheaper capital to enable the real economy to expand. We did see that shift emerge back in the second half of 2025, and the clearest example of that was in materials and commodities, where both the underlying commodities and related equities began to strengthen. We expect that trend to continue to be a driver through 2026. This concentration in mega cap technology we have seen has been a powerful trend, and it will take some dislodging for sure. However, there are forces shaping the global economy strong enough to see this broadening of beneficiaries persist through 2026. The escalation and modernisation of defence spending is a big one, as is the onshoring of manufacturing and the advancements in materials technology that's promoting. Energy demand is also accelerating rapidly, closely linked to AI data storage, and the infrastructure required to support that will be immense. The build out of all that will require materials where undersupply has been allowed to build up now for many years. Overall, growth should continue and market winners by sector and size should broaden. That likely supports an expanding risk appetite, which from a Tribeca perspective is encouraging. It is positive for small caps, for Asia Pacific and emerging market assets, and for materials. It also supports capital creation and equity capital markets activity, which is positive for our advisory franchise and expands the opportunity set for us as investors. Thank you.